Some members of the Bank of Canada's Governing Council are growing concerned that high interest rates may bring down inflation by more than necessary. The summary says some members thought the risk of inflation were balanced, with high shelter and service price inflation offsetting softness in the economy. Meanwhile, other members were more concerned that economic weakness may put more downward pressure on inflation than intended. The summary came one day after Statistics Canada reported that inflation hit 2% last month, finally reaching the Bank of Canada's target. Concordia University's Dr. Moshe Lander joined us for some perspective on the debate.
There's always going to be hawks and there's going to be doves when it comes to what to do with interest rates. So the hawks are going to always want to move slowly. The doves always view things as being not a problem. And so it's not uncommon to see that there's these discussions about how fast or how slow should we change interest rates. The same thing was happening when we were increasing interest rates. Hawks would have said, let's move aggressively. Doves would have said, let's take our time. Up until recently, we didn't get to see the minutes of the Bank of Canada's deliberations, so we never really knew what exactly was going on. And of course, if we don't see what's going on, when they come out, they make it sound like it's unanimous and everybody's happy. This actually helps with transparency then, because it's pretty clear that nobody's debating whether we should have an interest rate cut. It's how much of a cut should we be having. Inflation is meant to be between 1% and 3%. That's the Bank of Canada's target. I think that because it dropped so significantly to 2%, it's very likely that we're going to see inflation fall into the 1% range in the coming months. The Bank of Canada did warn that that was going to happen earlier this year, so it's not a complete surprise. The issue is if inflation were to fall below 1%, then as much as Canadians might like low inflation, it's not a good thing. If I can use a bad analogy, you need a little bit of grease to keep the wheel moving. And if you don't have enough grease, then the wheel will crack. And so you need to have a little bit of inflation to keep the Canadian economy humming along. Too little inflation, and you really risk gumming up things. So the good news, at least from the Bank of Canada standpoint, is that they have a large amount of space now to cut interest rates. Remember, we went from record lows to generational highs. So they do have all of that room to come down if they need it. And of course, the other thing that they have is unconventional monetary policy that in the worst case scenario, if inflation came in really, really low, they could print money and just drop it out of a helicopter and create inflation that way. So if we saw low inflation, it's probably something that's not going to be long lasting. And they have lots of levers to try and make it go back into that 1% to 3% range. Given a choice between having it too high, too low, I like having it too low because it's a lot easier to correct. We saw the pain that came from inflation being too high.